lots to be thankful for. And one of the things that I'm thankful for is the flexibility that we have in our relationships and the flexibility in the elasticity of my pants, because probably ate too much this week. But seriously, lots to be thankful for. And one of those things is that since November, the S&P 500 is up 8.5%, and NASDAQ is up 11%, and that does make people thankful.
It really does. And when I look at the market, especially since we did have a technical correction, and so in the lingo that we use, a correction is a decline of 10% or more from peak to trough. And we did go through a correction period with the S&P 500. A lot of that seemed to be triggered by fears around the rising interest rates that we had with the Treasury yields, the auctions, as far as when the government auctions off those securities, those were a little miserable. But we've recovered pretty nicely from that. And I think a lot of that has to deal with, we've had some pretty decent economic growth numbers. Inflation seems to be falling. And even though the Fed has gone on a fast and furious hiking pace, we're in this pause period, and that tends to be a little bit bullish for equities and for bonds.
So we'll just spend some time on the economic news, but I think there's also something that's been happening, and that has been this kind of feeling better about the relationship with China. That was part of it. True. After President Xi and President Biden got together. And lastly, earnings reports were better than expected. So I think all three of those together. But I do agree with you that the Fed news and the fact that they are in this Powell pause, as you like to say, certainly made the market feel better.
It did, and we got some confirmation of that this past week with the minutes from the most recent Federal Reserve meeting, and it was unanimous that they wanted to proceed cautiously, or I think they said proceed carefully instead of cautiously. So we always like to kind of parse the adverbs and adjectives that they use, and if everybody agrees that they should proceed carefully, that does mean that it is likely in this period where they're not going to hike anymore. They could if the data comes in to justify it, but for the most part, if they are done hiking, the key question then becomes how long do they hope that they can hold rates where they are?
Right, exactly. And of course, the market reacted to that. And the Fed does watch the market rates and the 10-year Treasury. I always joked, I'm sorry, professor and PhD of economics, that it's good to have those designations, and the Fed has lots of them on staff, but they also look at the markets. And as the 10-year Treasury and the 2-year Treasury started to react, they noticed those things.
They did. They are very concerned about financial conditions. They wanted financial conditions to tighten. And I think that, you and I, we speak to a lot of clients, and we know that financial conditions have tightened. You see higher interest rates. Banks are cutting back as far as with lending, raising their standards. But for the Fed, for some reason, they were still thinking that they haven't tightened enough. It's like, well, what more do you really want? It really took for that 10-year Treasury to jump up towards 5% for the Fed to finally take notice. So I'm at least thankful that they did take notice eventually.
And the second thing on economic news is the fact that we have been talking about a potential recession. At least we've been hearing about a potential recession for a long time now. And of course, we do understand that it takes negative GDP reports to get there. Again, not only do we have a really good, strong third quarter report, 4.9%, but the fourth quarter report is positive as well.
It is. And so the Atlanta Fed and the New York Fed, they both have these GDP trackers where it kind of uses real-time data to give you a read about, or at least a good guess about what GDP might be. And it looks like it's coming in anywhere from like 2 to 2.5% right now. So with the third quarter, next week, we're going to be getting the revisions. So that might actually be revised up to something closer to 5% growth for the third quarter. Then you ratchet down to 2 to 2.5%. That's not bad.
It's still positive.
It's going from great to good, which isn't bad at all.
And so we're going to look into the beginning of 2024 and try to speculate what's going to happen. But part of the big speculation is that the Fed is going to reverse course and start to lower rates, folks. And that's something that we've been looking forward to for a long time. Not only will the markets react to that, but if you've been looking for a mortgage, rates might start to come down in early 24 as well.